Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would usually be Michael Becker, but Michael Becker, the hardest working man I know, is closing another transaction. So joining me today, of course, is James Eng, Underwriter for Old Capital. Hey, James.
Good morning, Paul.
So in the podcast today, it's more of an educational podcast on multifamily. And we're going to talk a little bit about just different sources of people where people put some of their money to work at. And today we have Elizabeth Braman from Realty Mogul, based out of Los Angeles. We've done a couple transactions with that group, and I thought it would be a good educational piece to kind of talk a little bit about Realty Mogul and what they do, because they do a thing called crowdfunding. It's a fairly new thing. It's been around for a couple of years with some changes with the SEC and the way that people can accumulate equity from different groups. So I thought we'd kind of visit with Elizabeth, get her insight about what's going on. So Elizabeth, thanks for coming to the podcast. We appreciate your time.
Thank you so much for having me.
So no problem. So I'm going to kind of toss it over to James. Let's start our questions.
Sure. I mean, I think on today's podcast, we're really going to look at sort of 5 categories. We're going to start, very broadly about crowdfunding and sort of get an overview of crowdfunding, and then drill down into Realty Mogul, and then look at how Realty Mogul works with passive investors and then also sponsors. And then at the end, really just focus in on Elizabeth and her role at Realty Mogul and how you guys could interact with her. So Elizabeth, welcome to the podcast. Let's just kick it off. What is crowdfunding and why should real estate investors care about it?
It's a great first question. Thank you so much for having me. Crowdfunding is pretty much become the buzzword these days for what most people think of as old school syndications. In broader terms, crowdfunding can be taking a group of individuals to do something, of aggregating them to do something. So you've got gift-based crowdfunding, which is what you see on Kickstarter. You put up a product before you've launched it. People will pre-purchase that product, and then once the product is ready for delivery, they have purchased themselves a t-shirt or some new invention. Then there's charity-based crowdfunding, where a charity will put up a particular charitable function or purpose, and a group of people will get together and all invest in that purpose. And then there's equity-based crowdfunding, and that's really what the Jobs Act innovated on. So oftentimes we hear about crowdfunding and the Jobs Act. And what the Jobs Act allowed for was, for the first time, you as an entity that wanted to raise capital for a specific purpose to go out and raise that capital from non-accredited investors. So the difference between an accredited investor is a high net worth individual, as evidenced by making $200,000 a year or more, $300,000 if you're in a married couple, and or you have $1 million net worth, not including your house. So that bucket of people have primarily been the ones who have been able to invest in private placements, which is syndications, these kind of Reg D, 506B offerings that, if you're going out and acquiring a piece of real estate and you want to syndicate your equity, you could do that with friends and family because you had a pre-existing relationship with them. As long as you didn't advertise, you were able to go to these people who were accredited investors and raise as much money as you needed for a particular project. And that's been the old paradigm. And what RealtyMogul.com did was we created a website that allowed for sponsors in the real estate world to be able to raise capital using private placements, but doing it online. Because of the Jobs Act, we can now expand that, and we recently just launched an A+ REIT, so we can actually now raise capital from accredited investors as well as non-accredited investors. And so that's what crowdfunding is really all about, is the ability to take active real estate investors and match them with passive real estate investors.
Okay, that's great. So tell me a little bit about Realty Mogul and sort of how it got started and sort of the results so far.
Good question. Our CEO, Jillian Hellman, a couple of years ago was working at Union Bank and saw that the Jobs Act was really going to be a game changer for raising capital for any kind of project. She honed in on commercial real estate. That was her background. And so the company started about 3.5 years ago, raised some seed capital. A year later, got their Series A funded by Canaan, who's the same company that did Lending Club. That was our Series A. And then a year after that, we went out and did a Series B. So we've raised $44 million in venture. And in the last few years, we've put out $225 million plus in investments into cash flowing commercial real estate across the country.
And so when you say you've invested that much, so that's passive investors investing through your platform into these real estate deals. Is that right?
Yeah, some institutions, but for the most part, it's been we take a individual transaction or a fund or a portfolio, we underwrite the deal, we put it on our platform, and then we take all of the investors that want to invest in that deal, we put them into, and we call this the power of one, we put them into a single purpose LLC, and that single purpose LLC invests as one high net worth individual. So the sponsor, instead of having 50 investors come into their transaction, now has potentially only one investor, Realty Mogul LLC number 9. And that Realty Mogul LLC number 9 may have 50 people in it, but we're the managing member of that LLC. And that allows for the sponsor to only have to issue one K1, one quarterly report, and one distribution to Realty Mogul. And then we use technology to allow us to distribute and manage all of those investors.
So Realty Mogul is really a high technology company that's got all this venture capital that's been pushed over to it to try to expand its platform. And it's really like a Match.com.
In some respects, I would say because we're a broker-dealer, we're the only licensed broker-dealer in the industry where we're not only affiliated with a broker-dealer, we're also a broker-dealer ourselves. And what that requires is a couple things. One, we have to underwrite every single deal. So in so much as Match.com uses a lot of data to get it right, we also use a lot of data to get it right.
Sure.
When a deal comes into our platform, we underwrite from the ground up. We do what's called a zero-based underwriting. So for our investors, they can have confidence in the fact that an independent kind of party has reviewed, underwritten, and analyzed their transaction, and they're not getting the sponsor's direct numbers. And not saying that a sponsor is wrong. It's their project. They know it better than anyone. But it's nice to have kind of that extra layer of protection of having someone independent go in and re-underwrite the deal for them.
So talk through some, if I'm a passive investor, I'm used to writing, $50,000, $100,000 checks to individual sponsors here in Texas. Maybe talk through some of the pros and cons of why someone would go onto Realty Mogul and join as a passive.
Absolutely. So one of the things I was so excited about with our platform is because of the technology, we can take smaller check sizes and because we can manage a larger group of investors. So a normal syndicator probably doesn't want to have small checks coming in from their sponsors because it means their investors because they have to then manage more investors. On our platform, the minimum raise amount or invested dollar amount on most of our syndications is about $25,000 to $35,000. That means instead of going into one deal for 100, you can go into 2 or 3 deals. So you get diversification. And I really like that. I think the ability to go into different transactions in different areas of the country with different real estate profiles helps to diversify risk. And now we've allowed with the REIT for the smaller investor to be able to come in and do the same exact thing. We're pooling investment opportunities into the REIT and allowing for non-accreds as well as accreds to come in for as little as $2,500.
Okay, so if you go into an individual deal, you're thinking minimums are 15, 20,000?
It's usually 25 to 35,000 for a private placement, and that's accreds only.
Okay.
And then for the REIT, the minimum is $2,500. And we were very fortunate to have just distributed our first distribution, which was an 8% on an annualized basis. So not selling securities here, no guarantees that 8% won't go up or down, but the REIT is for the purpose of having a cash flowing vehicle. So we really looked at putting products into the REIT that would offer our investors cash flow. So we anticipate putting distributions out once a quarter for our investors who come into the REIT.
How would that REIT differentiate from just, a normal REIT that you would buy, like a Camden or something? How would that?
Great question. The difference between an online REIT and the traditional offline REITs is because our REIT is able to use technology, we're able to acquire investors in a very different way than the traditional model. So the traditional REITs went to market and used selling agents and broker-dealers, and traditionally they've charged 7 to 8% in order to sell that REIT. That is a fairly high fee load for any investor coming in. I don't know if many investors realized they were paying 7 to 8 cents on the dollar just as a selling commission. And that means that in total, a traditional REIT averages 10 to 15% of every dollar that you put into the REIT is going to not just that selling commission, but also fees and overhead. So if you're investing $1, you're really getting anywhere from 85 to 88 cents is actually going towards your investment. That's the traditional world. With RealtyMogul.com's new online REIT, because we are going direct to consumers, direct to the investor, to the retail investor, they're only paying up to 3% fee load once we've done our full capital raise. So that means 97 cents is actually going towards overhead expenses and management fees. So we think that's a pretty good value proposition to investors, that whenever they don't have to call their broker-dealer or to their selling agent or their RIA, they can go directly online and invest online into the REIT.
Okay. And then, so let's step back a little bit and go back to the, let's say, $25,000 investment into just a private placement memorandum. Do you have one of those deals that maybe you've taken full cycle and you can talk about the returns that the passive was getting on that, and sort of give us a little bit of background on that?
Yeah, so we've just posted a couple of deals on our homepage that can show the full cycle deals and what we've been able to accomplish. Because we only started the company 3 years ago, any of our deals that have gone full cycle have pretty healthy yields from a timing perspective. So you're going to see yields that may not be super indicative, but they're healthy. And so you're looking at things, I think, as low as 17% and as high as high 20s. But that has a lot to do with timing. Obviously, the shorter the time frame that you go full cycle, obviously the higher the yield is from a timing standpoint. We have done a number of deals all across the country. We have done quite a bit of multifamily in Texas. And so let me give you one example of a deal that we did recently. Was here in Arlington. We invested in a 91 unit multifamily that was in Arlington with a sponsor who purchased the property for $6.23 million. It was part of a portfolio. We invested $2.3 million, which was 90% of the total equity. We require our sponsors to bring in 10% of the equity net of their acquisition fee. And just to give you a quick example on as an aside on that, if you have a $10 million deal and you put $7 million in senior debt, you have $3 million in equity, sponsor would bring in $300,000 or 10% of that, and we would invest up to $2.7 million. And now that $2.7 million can be us alone, or we can come in pari passu with friends and family. I tell our sponsors to think of us as a high net worth individual who can come in programmatically and write checks. On our JV equity platform alone, we're writing checks in the $1 to $3 million range. Out of the REIT, we're writing checks $1 to $5 million, and that's on preferred equity and mezzanine. So back to the deal, it was a 3-year hold. They did about $500,000 in exterior capital improvements on the property and about $7,500 on a per unit basis. And then we're looking to increase rents by a little north of 20%. So the whole rehab plan would take them about 16 months, and then their goal is to sell it at around year 3. So that's a very typical real estate project that Realty Mogul does. A sponsor will come to us and we ask for 3 things. I need a model in Excel with a waterfall proposed. I need their offering memorandum or some kind of broker package so I can get to know the real estate. And I want to know their track record. So I want to see what deals they own in the market, how much assets do they have under management, what they've acquired, and hopefully they can even show me that they've gone full cycle on some deals, and they can show me whether they were able to execute on the business plan. Specifically, I want to know, can they do the business plan that they proposed to me? Is it realistic for them to be able to acquire this asset and be able to turn all of the units in 18 months and then sell it in 3 years? So once we feel comfortable, we schedule a call with the client, we go over our questions, we have them kind of pitch us on the deal, we go to our credit committee, we get feedback from them very early on in the transaction so that the sponsor can feel comfortable and confident that their deal has been discussed and pre-vetted, and then we go into underwriting. And that whole process from start to finish of us getting a deal, underwriting a deal, going and doing a site visit, getting through legal, putting it online, raising the capital and funding takes 45 to 60 days on the first one because you got to get through legal. And we're always working in tandem with the senior lender. So they're the ones that usually are slowing things up because they have third parties. But for the most part, we're looking to close right at the sponsor's close of escrow. We time things very, very well, and we're in constant communication and coordination with our sponsors.
So you went through sort of the steps that, the requirements that a sponsor would need to be a part of it. Sitting as a sponsor, why would I want to use Realty Mogul on a $2 million transaction versus syndicating it myself?
It's really up to the sponsor. There's a number of different reasons. We've had clients who have $1 billion in assets under management. And I always say to them, like, what do you need us for? We're, writing you $1 million check. And the answer is it's programmatic capital from an alternative capital source. So a lot of our sponsors have either tapped out their friends and family, so they can't go back to the well because I just got a deal and they just raised $8 million on one project, and now they've got to go back for another $2 million, and they just say, you know what, I just went and hit up all my friends and family and I can't go back to them again, but this new deal is super sweet and I want to take it down, but I don't have an extra $2 million that I can tap into. Or they normally use their own capital, and now they want to try raising capital externally. Maybe they don't have a friends and family network. And then a lot of our clients are institutional in quality, but the institutions aren't writing checks the size that we are. So we've done a lot of the $1 to $3 million checks because we're just like, again, we're like a high net worth individual that you can always turn to. And I don't know many sponsors who say that they wouldn't be thrilled to have another guy in their pocket who can write them $1 to $3 million checks programmatically. And that's really who we are.
Execution certainty is the biggest thing when you talk with somebody that has a pile of money. You want to make sure that you can put your hand in that person's wallet or pile of money. And Realty Mogul for a period of time has been providing execution certainty to a lot of sponsors. But those sponsors have to have a little bit of a track record. Tell us a little bit about the track record that if you're a sponsor, what's some of the criteria as a sponsor that you're looking for in terms of a track record?
I put our sponsors into 3 kind of buckets. So for us, the minimum sponsor track record is that as the sponsor entity, they've done $25 million in transactions. So they may only have $10 million under management currently, but they've sold off or bought and sold $15 million previously. That particular guy, we want to see that they've been in business for a couple years, they have staff of at least 2 or 3 people, they're a real estate company, not an individual investor, and that they're hyper-focused on a particular asset class and market. Then we've got our kind of mid-range guys. They've got maybe, let's say, 75 to 150, give or take, million in assets that they've acquired as a sponsor entity. They have maybe 5 to 10 employees. That guy, I'm going to be a little more comfortable going regional. So maybe he's a Southwest multifamily guy. Maybe he has assets within a 2-hour drive time from the asset that we're looking at. The third bucket is my big guy, and he's $250 million or $200 million and up. And that guy, I'm okay with going and doing a nationwide or looking at multiple asset classes because they probably have already acquired that asset in their history before, and they have a good story as to how they're going to be able to put boots on the ground and manage it. So oftentimes they are vertically integrated with property management, but not always. We hope that if they're not using their internal property management, that they have a relationship with their local property management company.
And what you're looking for is, at least the investor's looking for, is duration, how long the money is going to go out there and when it's going to be returned back, and the rate of return. So a lot of the transactions you guys look at to get a higher rate of return are a lot of value-added properties versus a stabilized, a straight yield deal. So you're looking to the sponsor's trying to take a property has a lot of deferred maintenance on it, things that have to be fixed. They're going to buy it at X. They're going to execute their plan by, fixing up the property. And then what they want to do is get everything completed. And then say return the money and either refinance the deal and pay their large investor Realty Mogul off or do something else. Is that kind of what you're looking for?
On our platform where we raise capital from high net worth individuals, the value add JV equity, that's absolutely correct. The REIT has a very different investment thesis. It's much more based on cash flow. So we are able to invest in things that are a little more core, that have they're less IRR driven, less sensitive to duration. So it's harder for me when going out and raising JV equity on the platform to do a 10-year deal, just because our investors don't like 10-year money, their money out for 10 years as much as they like it out for 3 or 5 years.
Right.
Whereas in the REIT, it's more agnostic to the hold term. We're looking at deals that are really all about the ability to cash flow.
So, we started pretty broad about crowdfunding, talked through some deals, sponsors from the passive standpoint. Let's talk a little bit about what you do sort of day to day at Realty Mogul, and then jump into that. Like, what do you do every day?
All right. Well, my everyday, it is a startup, so every day is a different day. I spend a lot of time on the road, going out and meeting with sponsors and investors and trying to educate people as to our platform and what we're doing and answer questions. There are different platforms and different business models out there. So when you hear crowdfunding for real estate, the top platforms all do it a little bit differently. And so that's one of the things that I often get calls on, is questions about why would I pick your platform over another platform. For example, we don't do any ground up development. We don't do any SFR, single family residential. Those are things that other platforms do. So I'm happy to chat with people and explain why we're no longer investing in hospitality, or why we are very bullish on office and on multifamily, obviously. So when I spend a good chunk of my day talking to sponsors and walking them through the things that we've discussed today, how our platform is set up, why someone would want to come and raise capital with us, and then obviously going over deals and talking through with them what we like about a particular deal, what we don't like about a particular deal. The majority of sponsors that work with us have probably sent over a number of deals before we get our first one done, getting to know us and seeing what's a fit, what we like, what we don't like, why we like it. We're a cash flowing commercial real estate investor. So not particularly interested in any special use properties, land and development. Those are the types of things that we're not interested in. So I spend a lot of time, I'd say, in education mode.
A lot of our listeners are either passive investors or sponsors themselves. Who would be a good, candidate in your mind to reach out to you to learn more about Realty Mogul? What would you want them to see or have?
I speak mostly to sponsors because I'm not a licensed registered representative of FINRA. The passive investors really need to talk to a registered rep, and they're the only ones that are licensed to sell securities. So I may broadly talk to a group of investors, but I don't sell securities. Any specific questions from an investor, a passive investor, someone who's looking to invest in a private placement or into the REIT, they should call into our website, has a number for the investor relations team. When it's a sponsor, I have a team of folks that work with me on originating deals. And if a deal comes in, we'll discuss who's going to schedule a call to discuss with the client what it means to work with us as a platform. And I sometimes take those calls, and I have other people that take it as well. We're growing in size rapidly, so we have a full team to address any questions from any investor type.
I guess start off, just maybe give us your contact information real quick, just so that if people want to reach out to you on any specifics on their next deal, then they would have it.
Absolutely. I am Elizabeth, Elizabeth, Braman, Braman, at realtymogul.com. You can also find me at realtymogul.com. I'm also on LinkedIn. I'm pretty easy to find, but telephone number is 310-907-4127.
Is there anything else that people should know that we haven't really talked about that can give them a more of an idea about what Realty Mogul does and brings to the table?
We have a ton of content on our website. We have an education center, so I encourage everyone to go and take a look on our website and see if there's any webinars or blogs or anything else that addresses some of their questions. We also do signing up on the platform is a great way to start getting email drips and get notified whenever we have a webinar about a particular deal. So once you register if you're an accredited investor and you sign up on the platform, you can see deals as well. You also are going to get invited to all of our webinars. So sitting in on a webinar would be a great idea as well.
I'm going to go back to ask one more question. If I am a sponsor and I am looking for money to help me fund a $10 million value-added property here in Dallas, I have to have a track record, being able to show you guys that I've done this a number of times, I've been successful at it. I have to kind of show you what my business plan is going to be. I got to show you that I can get a loan based on having myself as a sponsor of the deal and having, say, that you're going to bring in 90% of the equity into the transaction.
Up to, yes.
Up to.
If it's available, sure.
If it's available. And so then the lender has to be comfortable about having one large equity investor that's not going to sign on the deal.
Mm-hmm. Well, in truth, the investors that are coming into our LLC, they're not hitting the 10% threshold. So we'll just have a conversation with the lender to explain to them that no one individual is going to be a consolidated interest.
And so you've had success with bankers having no problems with doing that, and you've had success with Fannie Mae having no problems doing that type of stuff.
We've done over, I should get the head. It's over 60 deals. Yes, we have a full list of lenders that we've worked with without issue.
Right. So I think that's where my point was, is that having one large equity investor, it can still be done in lending, where typically if anybody has more than, say, 20 or 25% equity investment to the deal, we want them to sign. But because of the structure of this deal, it goes into, that money goes into an LLC, and it's going to be, the LLC is pushing the money into the transaction. We can work through that. And then you typically want 2 or 3 years of a duration for that money to be out, so you can fix the problem, the sponsor can fix the problem, and then refinance it or sell the property at the end of that period of time.
Yeah, a 3 to 5 year hold is our traditional or standard hold period. We have done 7 and 10 year holds as well.
And there's no minimum rate of return as a sponsor that I have to pay the equity investor into the transaction. Is that correct?
There's no minimum. I will say that we're seeking investments where we can offer our passive investors a minimum IRR of 15% net of fees. And we're looking for an average, this is average over the hold period, of an 8% cash on cash. And I tell sponsors, use both of those as your baseline. And if you move up with one, you can move down with the other, maybe not too far down.
Sure.
You don't want to go down with both of them below that unless you're in a very core market. And if you go above both of those, then you've got a pretty attractive deal.
Yeah, that's what I'm talking about, that Match.com, is that you have to have a good personality to attract the equity into your deal. So you got to show a reason why somebody should be getting into the deal. And so I think that's a success.
Yeah. And splits matter, but we do let our sponsors propose what their waterfall structure looks like, which is why I asked for a model in Excel with the waterfall. I want to see what the sponsor's offering. If it's not market, or if it yields an unattractive return, what we're going to do is then discuss with the sponsor how we can proceed with either tweaking it or whether or not we're the right partner for them.
And then how about areas of the country? I know we talk about, say, Dallas and Fort Worth, Austin, San Antonio. How about smaller areas of the country like maybe Tulsa or Springfield, Missouri, or some of these little smaller 25,000 and under population towns?
We look for 30,000 people in a 5-mile radius, which is still pretty small, but we're not a rural investor. So as long as it's got the right economic drivers, so we're looking for population growth, we're looking for good median incomes, we're looking for jobs in a good drive time. So we're looking very, very carefully at the demographics holistically of a particular market and might be interested in one part of Indianapolis, but not another part of Indianapolis. So it's really important for us to get some details on the deal and dig in to know whether or not there's no right answer to that question. There's nowhere we've said, no, we would never lend in or invest in this particular market.
Yeah, that's what I like about Elizabeth is that she has a background in lending, so she thinks as an underwriter, as a real estate person, not just an IRR person, thinks is more of the total of the transaction itself. Does this make sense?
It's a risk-adjusted return conversation, and our investors do know that. They may not be as excited about doing a 12% IRR and a 10-year hold, even in a core market. That may not be super exciting to them. It just means that we might not be able to invest as much money. So we're on the lower the yield from our investor standpoint just means that we're not going to look to write a really big check because our investors are more yield driven.
A couple questions on the sponsor side. Let's go back to that example. If, let's say they were thinking you were going to get 2.7, you go out to raise the money, you come up $500,000 short. Does Realty Mogul have a mechanism to backstop it, or does that go back onto the sponsor to come up with that additional capital?
We do. We can balance sheet if needed. We probably are, well, let me put it this way. We don't get over our skis because we don't overpromise and underdeliver. And what that means is that we set reasonable goals based on the many transactions we've done and know what we can hit. So we wouldn't go out and say, based on this particular profile, we're going to raise $20 million because we're not going to raise $20 million. We set usually we go out, we set a very realistic minimum. And we work with the sponsor, and as we're raising capital, if there's a lot of demand, we more often than not will increase our allocation. And so that's how it generally works. So you never want to put a sponsor in a position because we're a best efforts shop, because we're a nickel broker dealer, so we can't commit to, I'm guaranteeing I'm going to raise or invest $2.5 million. And in truth, this is where I kind of go back to sponsors and say, hey, we're just like your high net worth guy. If we say we're going to do a deal and then back out without a good reason, you're never going to bring us another deal. So we don't do that. We've never done that. But in truth, every single borrower in the world knows that up until the day that the funds are wired from their lender can back out and walk away. Again, you don't work with them again if they ever do that, but they have the right and the ability to, even if they've given you a commitment letter. The only recourse you have is to sue them. And if you sued a lender, they're going to come up with some material change in circumstance. That it just doesn't happen. There is a certain level of trust that we all have to have when we're working together, that we all have the same goal, which is to get the deal and the transaction done. So we work daily with our sponsors, sharing with them how the raise is progressing, what's the feedback on a particular deal, how the response has been. They do a webinar, so they get to sell it to our investors and share with them what they like about the deal and what their perspective is and what they think about the market. But you don't get into that situation where you said to them, I'm going to close with 2.7 and the day of closing you don't have it. That has never happened, nor would it ever happen.
No, that's a great answer. I mean, I think that's, from the sponsor standpoint, that's the worst thing that can happen is if, you're short on equity a couple days before close, whether the debt is short or the equity. So, I mean, thank you for coming in. This has been great. Not often do we get to sit with someone who is actually in the business. And I think we're just getting started on the crowdfunding piece, especially with real estate. I mean, a very small percentage of people invest in real estate. And so I think this is going to open up the doors for a lot more investment into the space.
Elizabeth, thanks for hanging out with us. We appreciate it. Thanks for all your information on Realty Mogul. If you have any more information, go onto their website. I think it has a ton of information. And remember, her telephone number is 310. Give it to me one again.
310-907-7134.
That's great. Thanks, Elizabeth. James, anything more you want to add?
Just a couple things. If you enjoy the podcast, please go onto iTunes and give us a high rating. That helps us reach more investors and other podcast listeners. And also, if you're looking for more information on multifamily finance, you can send an email to info@oldcapitallending.com, info@oldcapitallending.com.
Fantastic. James, thanks for hanging out with us. Elizabeth, thanks for coming to Dallas. We appreciate it, and we'll talk with everybody soon. Thanks.
Thanks.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.